This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss findings from the latest corporate earnings season for the first quarter and how it impacts markets. Investors always watch corporate earnings announcements carefully, but there's been extra attention on company results this quarter. This is because investors are looking for hints as to whether the economy is slowing or if it will continue growing steadily. After all, factors like high interest rates take time to filter through the economy and impact consumer spending and corporate profits. Over the next few minutes, we'll discuss the earnings outlook and why long-term investors should focus more on these trends rather than day-to-day stock market swings. First, it's important to remember that the stock market tends to follow the trajectory of corporate earnings over time, a pattern that is clearly shown in this chart. I like to explain it this way. Realize that when you own a stock, you are part owner of that company, just like if you owned a small restaurant or retail store. As an owner, how would you make money? Basically, more customers eating in your restaurant or buying your products. It's basically the same with stocks. So while investors often focus on the economy, we do not invest in the economy directly. Rather, we invest in the stock market, which depends on the financial performance of companies. In turn, how companies do depends on the underlying economy, including consumer spending, the job market, inflation, and much more. This chart also highlights how we can think about the stock market swings. During difficult periods when the stock market might decline, a strong economy will help to support stock prices. After all, if stock prices fall when earnings are still strong, valuations will become more and more attractive. The situation is different if the market falls due to an economic shock or recession. That's why bear markets tend to occur during recessions when it's unclear what the earnings outlooks might be. Thus, corporate earnings are among the most important factors for long-term investors. Next, this chart shows the earnings growth rate for the S&P 500 companies since the mid-1980s. What you can see on the right is that earnings struggled the past few years, but began to accelerate again in the third quarter of 2023. There's been a delayed effect between the steady economic growth and the corporate profits, but there are signs that companies are beginning to benefit from economic trends. This also matters because many valuation ratios depend on these financial measures. The price-to-earnings ratio, for instance, has risen significantly over the past 18 months as the market has rallied. The ratio is now around 20 times forward earnings since earnings growth has been stagnant over much of this period. However, with earnings growth now accelerating, the hope is that valuations will begin to look more attractive. Another way to put this is investors are anticipating stronger earnings growth, which led markets to rally ahead of time. Certainly, as we have said, we are not in the business of predicting the future, but rather preparing for the future regardless of what happens. So maintaining a properly, truly diversified portfolio is always recommended. Finally, this chart shows that economic growth has been steady over the past several quarters despite investors' concerns. In fact, the number of references to the word recession in corporate earnings calls fell to its lowest level in 2 years. Other sources of data, including the Federal Reserve of Richmond's CFO survey, suggest that corporate executives are increasingly positive on the economy. While these figures can change and are just a few data points, they are positive and do suggest that steady economic growth could translate into better corporate profits. The hope is that these also support the stock market, just as it has done over history. This is an important reason that investors should focus on these longer-term trends rather than daily stock market movements. We hope you found these insights valuable. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, please visit our website at dynamicwg.com or reach out directly by emailing us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.